Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, a tough move by the Bank of Canada, hoping higher rates will tame inflation. And as Canada bets the farm on electric vehicles, is it money well spent? Plus, when insurance companies refuse to insure, where does that leave us? That's all ahead. But first, for the week that was in business, it's time for the briefs. Call it tough love from Canada's central bank, moving to raise interest rates again to show it will take inflation seriously. The 0.25% move to 4.75% is aimed squarely at a consumer that continues to spend and a housing market that refuses to soften. The bank isn't making forecasts this week, but investors are now pricing in the odds of another move higher by fall.
I'm intrigued that people are now suggesting at least one more, maybe more, increases before the end of the year. And certainly that's where I would be. 2 or 3 increases, further increases before the end of the year.
Employment in Canada was essentially flat in May, with a slight decrease in jobs, or 17,300, concentrated among job losses for young people. The unemployment rate ticked higher for the first time in 9 months to 5.2%. But the number that may catch the Bank of Canada's eye was wage growth at 5.1%, bolstering its case for higher rates this week. Distress is already showing for Canadians when it comes to missed credit payments. In the first 3 months of the year, 1.1 million consumers missed payments on non-mortgage debt. That's an increase of 19% from the year before, and ominously, more of those households are also mortgage holders. A concern as some households come up on renewals on fixed-term mortgages and rates tick even higher. The World Bank raised its outlook for global growth this year as some of the world's biggest economies proved to be stronger than expected. It did cut the outlook for 2024, arguing that higher interest rates and tightening credit will take a toll. The Global Anti-Poverty Agency said growth overall will be 2.1% this year. That is adjusted up from its previous forecast of 1.7%. Office vacancy rates climbed in the first 3 months of the year, with the average rate now at 17.7% nationally. That's despite the economy holding its own, and it may signal a shift in how businesses will use the space. Newer buildings with better offerings to tenants are doing relatively better, but the softness is expected to continue as long as work from home is with us. Canada faces one of the worst wildfire seasons in its history, with millions of hectares burned, 10 times the average for the season. Air quality warnings in Ontario and Quebec were extended to parts of the U.S. this week, with major airports grounding flights, sporting events canceled, and people urged to stay indoors. And those are your business briefs. With some households already stretched, there are growing concerns about those with mortgages that will renew at sharply higher rates and now even higher. How big a concern is that? James Laird is co-CEO of Ratehub.ca. James, thanks for being with us.
Thanks for having me, Amanda.
So we know this is a concern because the Bank of Canada expressed it, that there is sort of financial system risk in the mortgages that reset over the coming years, all of them at this higher level than they originated at. Are we worried about that? Is that something that you see as kind of a wave of a problem ahead of us?
Amanda, I think that households are going to be stretched. Budgets are going to be tight. There's probably going to have to be some tough decisions made, maybe less eating and drinking out, less extracurricular activities. But unless there's been a job loss in the household, people should still be able to make that mortgage payment. I think it's important to remember that anyone with a mortgage right now, the entire $2 trillion of mortgage debt outstanding, it has been stress tested at 5 or 5.25%, which is about what people are going to be renewing at. So households strained, certainly, but I don't think they should break and not be able to make their mortgage payments.
A lot of people, as you would know better than anybody, were hoping that we were done with the increases in rates, that we might hold here perhaps, but some even starting to dream about declines. We could go even higher, right? The bank isn't sort of forecasting anything, but we see the market suggesting that by the end of September we have yet another one, and it could go beyond that if we see things continuing to be super strong the way they have been, including that housing market. What would you say to people about what to expect?
The Bank of Canada has been clear that they're going to get back to the inflation target of about 2%, and they'll do what it takes to get there. They thought they were done in January, but then everything has come in hotter since then. And so I think that it's possible there'll be another rate hike as early as this July in a couple of weeks. And that'll depend on the data that the Bank of Canada sees between now and then. And if things are moving in the right direction with less inflation, less consumer spending, and a little bit of slack in the labor market.
We did see, we got this data from Equifax this week showing that folks who are missing payments on debt, non-mortgage debt, so their credit card, their car payment, increasingly include homeowners, James, so people with mortgages. To your point, people may well kind of move the money around in a way that works for them, right? The mortgage payment is the one they have to make, so maybe they miss the credit card payment. What advice do you give people about other options? Is now the time to call your bank and say, what else can we do here about this, the mortgage or other form of debt?
Yeah, before you default on a mortgage or any other form of debt, you should certainly talk to that credit provider. In the case of a mortgage, there's a lot of options. Something that we're seeing regularly right now is the offer to extend amortizations. That's being supported both by lenders and by mortgage insurers in Canada. And that can have a very big impact. We ran some numbers. If you had a mortgage that started in 2018, and you got a 5-year fixed rate, it would have been around 3%. If you're renewing now at today's rates, and if you extend the amortization just by 5 years, your mortgage payment is going to stay fairly similar to what it was 5 years ago. So definitely don't just default. Talk to your credit providers. They're going to try to work with you to find a solution that works for you and your household.
Good advice, James. Great to have you with us for this. Appreciate it.
Thanks for having me.
James Laird is co-CEO of Ratehub.ca. Coming up, how much is it worth to have an electric vehicle industry in Canada? We're digging into the question of subsidies next.